Let's take a look at total cost analysis and see what happens when interest rates change utilizing the same purchase price of $250,000. So if we do a $250,000 purchase price, excuse me, we do a loan amount of 237.5, which represents a 3% down payment, we're going to show interest rate increases of roughly 0.5%. So whether rates are coming down or they're going up on a $237,000 loan, you can expect that payment to change by about $80 a month. Now, we've netted out the real estate taxes, the homeowner's insurance, and the mortgage insurance because those numbers will all be subjective to the market and specific properties. But if we want to take a look at exactly what it does to the mortgage payment, we just use the principal and interest, which is the money that gets paid back to the bank. And so once we know what that's going to do to the payment, we can scroll down to the chart at the bottom here, which right now I have designated for 7 years. And we can see that every time the interest rate changes by about 0.5%, it's going to cost you about $8,000 over a 7-year period. Now, if you take that 7-year period and divide it by $8,000, it's not terribly expensive. But if the value of that home continues to go up, and over 7 years, that property appreciates at a 4% value, you go from buying a house for $250,000 to a house that could be somewhere worth right around $329,000. Check out your equity position. Based on that 3% down payment on a $250,000 house, which is about $12,500, you've created about somewhere between $110,000 and $116,000 in equity, even if the interest rates are off by, let's just say, a total of 2%, right? But my point is this: if we wait for interest rates to change, whether we're predicting that they're going to go up or we're anticipating that they're going to go down, the one thing that we can almost guarantee is that appreciation is going to continue. So that $250,000 house in 7 years is worth $328,000, $329,000. That means that if we wait a year and interest rates do change, the likelihood of that property still being worth what it is today is not very good. So my point is always manage the payment, not the interest rate. You can only control where you want your monthly payment to be. So if you know that a payment on a $250,000 house is in the budget at $1,600 a month, who cares what the interest rate is? You can always refinance it later. But the minute you own that house, you start taking advantage of appreciation. If you have any questions, you can reach out at AndyLoan.com. I'd be happy to put one of these together for you. Have a great day.